Good morning, it's Jeff Christian. It's Friday the 13th of August. It's not quite 11 o'clock here in New York as I video this. The gold price and silver prices are up a little bit. Gold's around 1770, I believe. So we're seeing that. I want to start with a tribute to Herbert Coyne. Herbert Coyne was the co-chairman of J. Aron when I worked there. And he was one of three people for whom I worked that I just have the deepest admiration for. And I would always have been willing to go back and work for or with any of those three people. Herbert was just an exceptional person. If I thought I was smart, listening to Herbert would put me in my place immediately. You would have a discussion with people where it seemed like the scale was 1 to 10, and then Herbert would open his mouth and you realize, no, its scale is 100, 1 to 100, and Herbert's up there around 70, and everybody else is below 10. Herbert passed away, and it's a pity. Now, on a lighter side, I want a little bit of full disclosure. Last Friday night, I went to a concert, a free concert in a park here in New York. And during the introduction, they pointed out that JP Morgan Chase was one of the sponsors of the concert series. And I wanted to point that out because I'm sure there are some silver experts out there who will say the fact that I went to this free concert in the park that was partially sponsored by JP Morgan clearly compromises my independence as an observer of the markets. Also on a lighter side, one of those silver experts posted a really cute thing, and he was criticizing us and saying that I was part of the problem, part of the conspiracy. There's a conspiracy. It's Mike Lindell type stuff, but it was about silver instead of pillows or votes, Chinese bamboo paper. And he said, I'm really working to prove myself wrong. I really want to find out that there isn't a conspiracy and Jeff Christian isn't a ringleader in it. And I thought to myself, wow, that's weird, because like 95% of the people who own, buy, and invest in gold and silver in the United States can see that all of those conspiracy theories are utter nonsense within 10 minutes. So I'm not sure what he's doing that he's working so hard to prove himself wrong, but he's probably barking up the wrong tree. Now, I have kind of a long presentation today. I will talk about what happened to gold and silver last Friday and this Monday. I will talk about where we think the market's going next. I want to talk about the Fed and economic volatility, because it's a granular, important topic, and there's a lot of miscommunication on the part of the doomsday boys. Oh yeah, the Fed is screwing this up, and the Fed doesn't know what it's talking about. And yeah, they've got thousands of economists with PhDs who have studied this stuff and worked in the financial markets all their lives, but I know better. So I want to talk about that, and I want to talk about the relationship between the Fed and banking, really, and economic volatility. And then I want to finish up with some commentary about just commentary on the market and some of the things that people say that are just funny and wrong. So what happened with gold and silver? It's hard to act surprised when something that you've been saying is going to happen happens. We've been talking for months about the idea that once we got the August COMEX gold roll behind the market in the first week of August, we would see gold and silver prices come off sharply. The same price pattern happened in July and August of 2019. The same price pattern happened in July and August of 2020. The same price pattern happens across commodities when you have active months rolling forward. It's not gold and silver. Take off your gold tinted glasses, your silver tinted glasses. Look at the broader financial markets. It actually happens in non-commodity markets too. So no surprise, we're not there. There was no flash crash. That wasn't a flash crash, and it wasn't a smackdown. It was the market behaving the way markets behave. Yeah, you had the August COMEX gold roll behind. But there are a lot of disenchanted investors out there who feel that they were lied to about the ability of silver to rise to $100 and gold or $1,500, or gold to $10,000, that hyperinflation was about to happen, that the global financial system was crumbling and the dollar was collapsing and the stock market was going to fall 86% in the next week or two. Anytime now. So there are a lot of disenchanted investors who have been selling gold and silver over the last few months. That plus you have financial market attitudes becoming more positive toward economic prospects. They're seeing that we're coming out of the recovery period into an expansion in the United States. They're seeing substantive investments in construction coming down the road in the United States, presumably. And there's more optimism there. So better view. And let's be honest, the S&P has closed at record levels 46 times in the first half of this year. That's about a third of the trading days. Got to point out that financial markets don't trade in the United States on Saturdays and Sundays. Somebody got that wrong in his nasty little comments about me a few weeks ago. No, Saturdays and Sundays we take off. So you have better financial views. You have the August roll behind you. You have disenchanted, stale bull liquidation in gold and silver. And a lot of people go away on holidays in August. Not only investors, but also fabricators, electronics companies, jewelry companies. They close down for 2 weeks. They take inventories. Many of them, if they're using the raw material in the first instance, gold or silver, will actually vacuum their factories and then refine the dust to do it. So you had a number of factors that were there. And that's all that happened. I hate to say it, no flash crash, no smackdown, no conspiracy, nothing to see here. Actually, there is something to see here. It's a great buying opportunity. Now, this is a slide from 2013. April 2013, the gold price fell sharply. It had been finding incredible price resistance to rising over 1620, 1640 at the time. It fell below 1580, which was a support level. It started to fall further. And then one day in April, starting in Asian markets, actually one bank came in and said, we have a lot of gold that investors have been selling because the price isn't rising and the stock market's rising. And we've been holding it in inventories, thinking that investment demand was going to come back. But investment demand's not coming back anytime soon. So we're going to sell, it's like 160,000 ounces, if I recall correctly. That triggered a stop loss order that was placed by literally more than 1,000 entities sell gold. And the price fell something like $140 in a 5-minute period. Of course, the doomsday boys said, oh my God, it's a smash down, it's a crash. Goldman Sachs probably did it, or JP Morgan working for the Fed. In reality, it was more than 1,000 discrete entities who were looking at the same price, using the same technical charts, saying, hey, if the price falls below, I can't remember what it was, 1440, 1420, this is a big sell. A lot of people placed orders overnight, so they were asleep in Europe or the United States when the selling happened. A lot of people were at their desks throughout Asia, and it was there. It was great because when I pointed that out at a conference, Silver Metals and Minerals Investment Conference later in the year, somebody said, you mean the Fed has more than 1,000 agents who they can call up and say, let's whack this thing? I said, no, I mean there are more than 1,000 people who trade gold and silver. Now this table we pulled together for that conference. It was the larger, outsized, unusually large volume, 10-minute periods in October of 2013. And you can see there were 7 periods in which enormous volumes not enormous, but unusually large volumes came into the market. 4 of them were buying opportunities and the price shot up. 3 of them were selling opportunities and the price fell. In each of those instances, there were hundreds of entities buying or selling based on technical analysis, not because the Fed called them up and told them to sell. It's really that simple. Distributed investment. People have their own choice. So A, it's not a smackdown. B, these kinds of activities are not unusual in gold, in silver, in other commodities, in bond markets, in stock markets. This is how markets act and behave. And 4 of the 7 times that we grabbed just at that one time were actually buying opportunities. Someone was smacking the price up, not smacking it down. Now, why didn't I update this since 2013 to make my point? Because it's inconsequential to the market. It's a giant distraction by a bunch of snake oil salesmen who are trying to scare you and think that make you think there's a grand conspiracy. Don't let them do it. Get on with life. So what do we think now? We're considering consolidation and possibly further declines in gold and silver during April. We've said this over and over again. We think that gold could go back and test 1680 yet this month, maybe even fall below it as it did this past Monday. We think silver has an initial technical target of $22 that a lot of people will be shooting for. If the price falls to $22, they might unwind their shorts and go long, because that's what people do. I'll get to that at the end. There's a great question that we got from last week's video related to how markets work, and I'm going to answer that and address that at the end. Jackson Hole comes up. That's the Kansas City Fed's annual conclave out in Jackson Hole, Wyoming, 26th through 28th of August. A lot of economists from around the world and from various Fed banks and from the Federal Reserve Board in New York, in Washington, will be there talking about what they see going on in the economy. And part of the discussion is going to be stronger economic growth, less need for monetary support and accommodation, i.e. tapering. We've seen earlier this year that even somebody thinking about that at the Fed can cause the markets to fall, not just gold and silver, but also the stock market. You should expect that kind of commentary and discussion at Jackson Hole, and that could be the occasion for another round of selling that could take gold back down to 1680, silver's 22. However, it's in the market. It's already baked into the markets. The writing's on the wall, and we see this, and markets tend not to wait for the news. They'll sell on the rumor, buy on the news. So we think that August could still see lower prices, consolidation around current levels, lower prices at some point in the month. Going forward, we have been saying, and we continue to say, that we expect prices to start rising in the last 3 or 4 months of the year and through 2022 on a moderate basis. There's a proviso, I'll get to that. Investors will return. Yeah, the economy is better, but it's not great. And there's a lot of issues that we have to deal with. Not just economic, but also financial market issues and political issues. I doubt that Mr. Trump will have been restored to the presidency back then, but we'll see where we are in September and October. Investors will return. Fabrication demand is expected to strengthen modestly going into the end of the year. Jewelry orders for year end, for everything from Diwali and Hanukkah to Christmas and Lunar New Year in early 2022. Jewelry orders will start coming in to the fabricators, and the fabricators will be buying gold and silver to meet those orders. Electronics also picks up at this time, so you'll see fabrication demand. I think I've mentioned it before, but in March, April, and May, we saw central banks, more central banks and unusual central banks, buying significant amounts of gold, 300, 500, 600,000 ounces. more than 1 million ounces for a couple of them, Hungary and Thailand. We saw central banks buying gold in that 780 to 1840 range. More central banks buying more gold at higher prices. They're signaling that they thought that $1,800 was a good price to buy gold at a long-term basis, as we've been saying. And so I think that there's be stronger central bank demand there. We're seeing record amounts of reverse repos at the Fed right now, where you're seeing a lot of people turning in dollars and taking their own currencies back. So there seems likely to be continued interest in adding to your long-term gold holdings on the part of central banks. And that should support prices for gold in the final 4 months. And seasonal strength should help, as I said. Cautionary note is the risk that prices stay weak through the rest of the year. We saw this pattern in 2019 and 2020. Seasonally, July and August traditionally are the weakest time for gold and silver prices, and then they strengthen over the last 3 or 4 months of the year. But in 2019 and 2020, and I shouldn't need to say it, but I will say it, the two most recent experiences, we saw prices rise in July into that August COMEX delivery in the first week of August, and then decline through the remainder of the year. That gives us some pause about our view that the gold price and silver prices will start recovering in the final 3 or 4 months of the year. Partly because that investment disenchantment remains in play. So we're still worried about that. Now, I want to talk about the Fed and economic volatility. And this could seem esoteric, but it's not. And in order to talk about the Fed, we have to talk about the US economy and banking prior to the creation of the Fed at the end of 1913, and actually the organization of it in 1914. In the earliest days of the Republic, 1791 to 1811, we had the first Bank of the United States. It was a national bank, right? There were political opponents to it. Those political opponents, as I'll point out in a second, actually had their campaigns and their finances intertwined with people who ran state banks. And so in 1812, they ended the first Bank of the United States, immediately throwing the country into a deep and prolonged recession. There was massive counterfeiting by state chartered banks. And those state chartered banks were run by people who were successful bankers, who were paying off politicians to make sure there wasn't a national bank. It was so bad that in 1817, we created the second bank. And notice I said we created that bank. That comes into play when you start talking about the SLV and who created it. We created, as a country, the second bank in the United States. People who ran state chartered banks, who were free to print their own money because they were supposed to have gold or silver backing that, but their states usually didn't have auditors going around to check. So you ostensibly were taking in gold and silver and issuing your own bank's currency based on the fact that you had a 12% cover or whatever the reserve requirement was back then. I think it was actually 40% cover. And the bankers realized that no one was checking on them, so they could print paper money until the cows came home. There's massive amounts of counterfeiting, and they paid politicians to make sure there was not a nationally chartered banking system where you'd have audits of these banks. They paid a guy named Andy Jackson, who became president and got rid of the second Bank of the United States. And lo and behold, we fell into a deep and prolonged recession. Strange how that works. From 1837 to 1861, we just had a lot of problems. As students of history know, slavery was only one of the issues that the country couldn't deal with. 1870 to 1898, we had 3 major depressions, bouts of hyperinflation, massive fraud at state-chartered banks, repeatedly precipitating bank panics, and economic crises. I had a 3-hour interview I did with Alan Greenspan for a client in Hong Kong in early 2019. And it was very interesting because I asked Alan, hey, you're a gold bug, or you support a gold standard and stuff. But you look at this, and there are people out there who will tell you that the creation of the Fed, that's where this is going, has increased economic volatility in the United States, which is statistically inaccurate. Alan, what do you think about it? And he said, well, of course we had major depressions and periods of hyperinflation. We were on species. The currency was backed by gold. And we'd run out of gold and we'd have hyperinflation. And then we'd have a lot of gold and we'd go into a depression. Of course we had depressions and hyperinflation. We were on a gold standard. That occurred. From 1870 to 1930, we had 3 full-fledged depressions and 11 prolonged recessions. I'll show you a chart in a second. From 1907, we had a bank panic that was in a total panic. And it's very important because someday I'm going to talk about the plunge protection team at the Treasury. In 1907, we had a major bank panic that almost destroyed the global economy, similar in some ways to what we saw in 2008. And JP Morgan, the man, and his bank personally kept the world's economy and financial system afloat, putting tens of millions of his own money into it. At one point, things got so bad that he called the Treasury and said, hey, do you know what's going on up here? And the Secretary of the Treasury said, no, I don't. So well, you ought to get up here and see what's going on. That was the kernel of thought that created the market oversight at the U.S. Treasury, which spurious and nefarious people call the plunge protection team, which doesn't actually exist to protect against plunges. It exists as an interagency task force to try to monitor the markets to see what the heck's going on. So from 1907 to 1913, we had a series of recessions. 60 months of the 90-month period was spent in recession. And we had several banking panics at the same time. So that at the end of 1913, and no one could do anything about it, because when the administration said maybe we should have a nationally chartered banking system where we can monitor these banks and make sure that they're not counterfeiting currency, the politicians in Congress who were being paid off by bankers blocked it, which is why the creation of the Fed was somewhat surreptitious, because the banking interests politicians in Congress would not let a nationally chartered bank be created. Corrupt bankers prefer state regulation. It's really that simple. And they worked very hard into 1913, and they worked very hard after that, and they're working very hard now to convince people that we don't need a nationally chartered bank with auditors making sure that the banks are doing what they're supposed to do. Even today. Now, there's nothing new under the sun. Crypto guys, governments and central banks around the world are looking at cryptocurrencies and saying, gee, this stuff's a giant scam. I mean, it's not exactly a Ponzi scheme, but it's nonsense. It's hollow, there's nothing tangible behind it. A lot of people are gonna lose a lot of money. And until this year, central banks and financial market regulators have said, we're gonna let that happen. We're not going to be the bad guys who come in and say, hey, this party's over, you guys are smoking ganja, I don't know what you're doing, but these cryptos don't make sense. Somebody's going to lose a lot of money. We got to unwind this. Banks, central banks, and financial market regulators said, we're not going to be the bad guys. We're going to let this thing collapse, and we're going to let a lot of people lose a lot of money, and it's all going to be in the free market. Now we have this guy, Gary Gensler, at the SEC, and he's saying, no, we really ought to step up and do our job as financial regulators. The cryptos are crying, oh, no, 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 we have decentralized autonomous organizations. They'll take care of regulating these things. We don't need government telling us what to do, which is exactly the same argument that the state chartered banks used for more than 100 years to screw over the country and to counterfeit. And it's probably also tied in with the whining about big banks by less than reputable coin dealers, because Gary Gensler, when he was at the CFTC, was trying to bring OTC, gold and silver and commodities activity under CFTC guidelines because there was so much bad behavior. We won't call it malfeasance, we'll call it misfeasance. So the nefarious operations and opposition to national banking that we hear today from certain politicians and their political supporters is the same as what we've been seeing all along. Now, here's the economy. It only goes back to 1850. This is GDP. Take a look at it. You don't even have to study the numbers. You can be a visual kind of guy and say, wow, here's 1913. This is when we started the Fed. These are all those recessions and depressions that I talked about in the 1880s and 1890s. Look at the size of the depressions in 1907 and 1912 and 1913. And then this is the Great Depression, and this is 1947. And compare that to everything that's happened since 1947. We have a far less volatile economy, just measuring real GDP, than we used to. The Fed was created back in 1913. It lived through the 1920s. It was cutting its teeth. It had the Great Depression and World War II to deal with. But after all of that, by the late 1940s, things got a lot better economically, but also in terms of monetary policy. And there was a fellow, William McChesney Martin, who was a very smart guy. He didn't go to the same high school as I did, but he did grow up in St. Louis as I did. And he was probably the best Fed governor ever. I believe he was the Fed governor from 1951 to 1970. And he is often quoted as saying the Fed's job is to bend into the breeze of inflation. So when we see inflation coming down the road, we try to nip it in the bud before it gets to be too bad. And from 1951 to 1970, he did a pretty good job. After he left, we went from having people who knew about banking, and it's been said that William Chesney Martin actually was raised to be a Fed governor, the Fed chairman. His father, I think, was a banker too. After he left, we had a series of political appointees who contributed to the hyperinflation and recessions that we saw in the early 1970s, 73, 74, and then 80, 82. Paul Volcker took over in late 1979 and restored logic and order to central banking. But you can see 1850 to 1990, 16 recessions with an average longevity of 22 months. 1945 to 2009, and again, I didn't bother to update this. Actually, the chart is updated to 2021. 1945 to 2009, roughly the same length of time, 11 recessions that lasted 10 months on average. So shorter, shallower recessions and fewer of them after the Fed was created and once we got behind the Depression and World War II. And take a look at the recession that we've just gone through and compare it to 1947 and 1930s and all this stuff in the 80s and 90s, 19th century. The economy is far less volatile than the good old days. And the good old days were characterized by a gold standard. And then if you just take a close-up, 1945 to 1983 compared to 83, 2007, it got even better. And 83 is after we got out of the recession that Paul Volcker engineered by raising interest rates in the final quarter of 1979, which, by the way, was a big transition in the way monetary and fiscal policy operated in the United States. and was a period when gold went from $200 to $850, and then back to $280, and silver went from $5 to $50 back to $16 and then lower. So the Fed has not necessarily contributed to it. Now, there are people who said, oh, the Fed didn't help in the Great Recession, 2007, 2008, 2009. And these charts are kind of hard, but you can go back and study them. These charts look at what the economy would have done without the Fed's monetary accommodation and with it. And you can see with it, we had a recession in 2009, and without it, the recession would have been twice as large. We got into a recovery in 2010, we would have had a small recession, and we probably would have dipped back into a deeper recession in 2011, but for monetary accommodation. On unemployment level, unemployment shot up in 2009, 2010. It would have shot up even more. And then here's the data that justifies all that. Despite what you've been told, the economy has been progressively less volatile up until the Great Recession. And you can see here, again, this is an older chart here. Do you think that the post-1982 stability has ended? Yeah, it clearly has. We've had two recessions that were very deep compared to everything that came before 2007, or between 1983 and 2007. So we're less stable than we used to be, but we're a lot more stable than we were prior to the creation of the Fed. Now, why do I tell you all this? Well, I say it because I'll tell you a funny anecdote. At one point, I was talking with a group of people in Washington, and Ron Paul was there. And Ron Paul has staked as one of his tenets of life that the Fed has increased volatility in the overall economy. And this is just GDP. You can look at unemployment, you can look at inflation, and the Fed's not the only one. And the Fed does monetary policy, fiscal policy has had a lot to do with it, as have private activities in the private sector. You don't want to downplay all of that, and I don't want some person saying, oh, well, Jefferson focuses on monetary policy and says the Fed's the source of all good things. No, the Fed's not the source of all good things. And as I've often said, and these guys can go plowing back through my old presentations and find it and then distort it. As I've often said, the Fed cannot engineer economic growth. It can stanch the economic bleeding. Fiscal policy is necessary to stimulate consistent, sustainable economic growth. The Fed is there to stanch the bleeding, as it did in 2008, 2009, 10, 11. Right? So I said to Ron Paul, hey, dude, you know, Alan Greenspan can be honest about this. Why do you keep saying that the Fed is a source of economic volatility when you look at GDP, you look at inflation, you look at unemployment, and it's clearly not the case? And he walked out of the room. So over the ensuing decades, I would approach him publicly and privately and over again, say, hey, dude, you know, come on, can you explain your beliefs in the face of statistics that sort of say you're wrong? And he has gone out of his way to avoid me and to avoid addressing that question. I won't bore you with some of the funny things that he's done, but for decades, he's done it. Now, the worst sin in my view, well, no, I have other sins too. The worst sin I can see, very bad sin, is not changing your opinion despite numerous attempts, despite an overwhelming amount of evidence, and empirical evidence, that you're wrong. He was also dead wrong about the Treasury's gold. And for decades, he kept saying, oh, we should audit the Treasury's gold. Finally, in 2011, toward the end of his congressional career, in 2013, his colleagues in Congress allowed him to hold hearings, and he brought in a couple of people from the General Accounting Office and the Treasury to talk about it. And it was very good. I mean, I've got the link down here for the hour-plus hearing. At some point, he says, you know, in preparing for this, I was told for the first time, apparently, that the Fed actually audits its gold every year. The Treasury audits its gold every year, and it posts the summary results of those annual audits on its website. No one ever told me that. And I was also told that the Treasury has undergone a deep dive where they counted and weighed and checked the serial number for every bar. 261 million ounces divided by 400, you figure out how many bars that was. Hundreds of thousands of dollars and years to do this. And they took a sample, a representative sample, and they took assays of it. And they gave him that report as a result. So he's been dead wrong on the Fed causing economic volatility. He's been dead wrong about the Treasury's gold not being secure and audited. And in that hearing, there's a really funny place where he says, oh, there's a lot of distrust about the Treasury. He said, yeah, dude, you're the guy in Congress who has been breeding that distrust. You're the guy who's for it. And the third sin, after he left Congress, he said that he started a little war against an imaginary federal government plan for mandatory psychiatric screening for children against depression and other psychiatric problems. The problem was there was no such proposal for any mandatory screening of children. Just wasn't there. But hey, if you can make a man out of straw and then knock him down, some fool somewhere will believe you. Now, I don't want to pick on Ron Paul, but he's one of the most respected commentators in this group. And he's just been dead wrong. And as I've said to investors in the past, and I'll say it again right now, walk on. It is Friday, so we'll have some scotch tonight. This is the best book on the US banking system prior to the Fed, A Nation of Counterfeiters. Get it, read it. It's a fabulous book. And the counterfeiters, obviously, are the state banks. Now, research versus commentary. I want to talk a little bit about this. Here's a question that we got in response to last week's way too long video. And Uncle Putin asked, so the game is that the bondholders can make money as long as the stock market and the bond price rises. What happens if they don't? And the answer is, this is a common misperception. We're not talking, as if you go back and listen to my previous video last Friday, we're not talking about equities. We're talking about equity derivatives. Equities are about a $100 trillion market. Equity derivatives are several quadrillion dollars. And equity derivatives, like mortgage-backed securities, give you the capacity to go long and to go short. So the people who have been making money with this engineered stock market that has just almost uninterruptedly risen since 2010 to the present, when the time comes and that game is over and the stock market's going to fall, they will buy short derivatives and they'll make money on the way down. Heads, I win, tails, you lose. Here's another book worth reading. It just came out, High Conflict, and it talks about how the difference between good conflicts, where people say, hey, I have a view, you have a view, let's practice the Ignatian presumption, and you tell me what is behind your belief system, I'll tell you what's behind my belief system, and we'll see if we can convince each other or maybe even come to a consensus. That's good conflict. High conflict is where someone gets their back up. And one of the things that we've discovered recently is that there are businesses that get paid to generate high conflict. And one of the businesses has been prominent in the gold and silver business for decades. talking about how the dollar is going to collapse and civil war is going to break out and the dollar's in a free fall. And that company, they work under all kinds of shells. So you have to go and you have to search what, here's something about politics. Here's something about race. Here's something about critical race theory or whatever it's called. Here's something about the election fraud. You have to go and you have to say what company is producing this email and who owns it. And a lot of them come back to the same guys. They've made a fortune spooking investors for a long time. And now they're making a fortune spooking people about politics and social unrest. Black Lives Matter is a Marxist association. Actually, I don't think it's even an association, but it's there. Let's see what else I have here. Let's stay here. I'll stay here and talk about a few other things because I said I would talk about the difference between research, which is what we do, and commentary. I'll start with an anecdote. In 2008, Doug Casey invited me to speak to his Crisis and Opportunity seminar in Scottsdale, Arizona. It was 2008. The world was kind of shaking apart. The housing market was collapsing. Gold had risen up over $1,000 and then fallen back a little bit by the time this occurred. And Doug feeds on self-made millionaires who are frightened that their self-made millions are going to be taken away through taxes or taken away through other things, or they're going to lose it. So it's a fear-driven thing. It's all about the crisis. And in May of 2008, we had crises to talk about. And there was this panel of experts and me. I said, I'm here to talk about the opportunities. And one of the questions of the panel was, is this the end? And they went through, yes, it's the end. Yes, it's the end. James Turk had the best response. But he went through 5 of these guys, I think, and said, they all said, yeah, it's the end. And I said, the end of what? This isn't a movie. It's not a book. This is real life. If it's the end, what's it the end of? And if it's the end, what happens tomorrow? Can we ask that same question and ask for elaboration of these people? And then I'll give you my answer. We went through and the first 4 guys said, yeah, it's the end, but I'm okay because I own gold. So I'll be able to eat and buy cigarettes tomorrow. James had the best answer. He said, yeah, I think it is the end. The system's going to collapse and we're going to have to nationalize 1 or 2 or maybe 3 banks here in the United States the way the UK has nationalized Northern Trust earlier in 2008. So, wait. You guys have missed the biggest bond market rally at the time, the biggest stock market rally at the time, decades of prosperity, because you're waiting for the end. And when the end comes, you nationalize a couple of banks. Now, we didn't actually nationalize banks, but the way they poured $1 trillion into the top of the 6 banks is a quasi-nationalization, you could argue, if you really wanted to argue. But I don't like to argue. So you got this incredible doomsday nonsense, and it's pervasive in gold and silver. It's pervasive in other financial markets and currency markets and politics and social issues. And there's an entire range of people that are doomsday boys, snake oil salesmen, carnival barkers, whatever you want to call them. Some of them are being paid by people to do that. Some of them do it because they like to light cats on fire and stuff like that. I have tended to use the name Mike Maloney, and I only do that because Mike made the mistake of making fun of me in May or June, early June. And then when his bosses said, you ought to apologize to Jeff, he dumped on it and heaped even more insults on me. And that makes him fair game, right? So, but we don't want to pick on Mike because there's a whole range of people. And one of the things I've seen in the comments of these videos is, great, who's he talking about? Because he's not naming it. It sounds like it's Mike Maloney, but maybe it's this guy, or maybe it's that guy. It's really the whole group of them. Let's be honest, it's an enormous group of people. And going back to the whole thing about paid, there's a very interesting article, I believe it was in the New York Times a week ago, about companies being paid to knowingly spread false information about financial markets, social and political nonsense. Yeah. So you've got these things going on there. And it's interesting because I think that we're actually having a positive effect here. We've seen some of these guys start talking about trying to justify the fact that they've been wrong about the imminent collapse of society and the dollar and the financial system and the bond market, and they're trying to justify it. And again, I don't want to pick on Mike Maloney, but he's going out of his way. Maybe he's trying to justify this because I said, hey, let's not talk about his haircut. Let's not make little prepubescent videos about him with cartoon characters. Let's talk about his track record of being wrong. And so like last week, he came out with a video and he said, look, when I was talking about the imminent collapse of the dollar and silver going to $1,500 and gold going to $10,000 back in 2003, I was talking about over time. And he went on and on and on, talking about how long it takes for an international currency regime to change, to come to an end. And it was all justification for the fact that for 18 years he's been wrong on gold and silver and the collapse of the economy. And it's funny because he said, well, no, in 2003, I wasn't talking about this being imminent. I was talking about it someday. And actually, if you go back and look at his videos, it was imminent. It's like, next month or the next few months or the next year, it's gonna happen. And then he said, the classic one, I'm okay because I have gold. No, he said, I've been in gold. I've been long and wrong since 2003, but that's okay because I've outdone the stock market. So, because I'm me. So, well, the stock market has actually risen about 390% in capital terms, index, since January of 2003. Gold has risen 403% through July in the same period of time. So on a purely capital appreciation basis, yes, you would have done 402%. I'm sorry, I don't want to be accused of lying that it was 403% when it was only 402%. You could say, okay, you would have beaten the stock market by 12%, except for the fact that the average dividend over that period of time of the S&P 500 was 1.86%, which compounds to another 41%. So if you had been invested in the S&P, which is kind of a mindless thing to do, which is what everybody does these days, you would have 390% capital appreciation, another 41% in dividends. You would have had 331% return compared to 431% total return compared to 402% in gold. Now, speaking of the S&P, there's a little peccadillo for Ron Paul's son, having had his wife buy a stock when he found out that they were working on a COVID treatment. Interestingly enough, that is the first individual stock that he or his wife have bought in at least 10 years. So it's not like, hey, I'm buying this stock. It's like, hey, I never buy stocks, but I heard about this, so I'm going to buy this stock. Sort of like the 19th century bankers in some ways, right? It's very strange. I do take some pleasure in the fact that folks seem to be scrubbing my old videos, looking for things that I said that they might distort and say that I lied. I did make a comment at some point that someone grabbed, in which I said we created the SLV at some point. And I was talking about we as in the world or the market or the United States. I wasn't actually involved in the creation of the SLV on the part of the people creating the SLV. I am on record, it's a matter of congressional federal record, that I was advising the SEC about issues related to non-gold ETFs at the time the SLV was being proposed and seeking approval from the SEC to trade. So it wasn't we. Sorry, boys, syntax is everything. English language is sometimes complex for some people to understand. There's also a comment about JP Morgan and me. And honestly, it wasn't clear to me even what they meant, but their logic didn't seem to hold together. I think they were talking about the fact that because I went to that concert last Friday, it was clear I was in cahoots with JP Morgan. Sonny Boy Williamson was an old blues musician, and he was in London in the 60s playing with the Rolling Stones and the Who and Eric Clapton and John Mayall and all these other guys who were British and wanted to play the blues. And the London Times asked Sonny Boy Williams, "Why are you here?" And he said, "Well, these British boys want to play the blues so bad, and they do." So that's the difference between research and commentary. That's all I really have to say today. I hope you enjoyed it. Have a good weekend. Stay cool if you're in North America, and we'll talk next week.